So, good evening, everyone, and welcome to this evening's panel discussion. My name is Lutfey Siddiqi. I'm a visiting professor in practice and a member of the advisory board at the Systemic Risk Center here. Today's topic is highly topical and highly timely. Financial regulation when the government goes for growth, right, goes for growth. I guess the basic idea is that if the objective of the government is growth, in fact, I think it's, I quote, growth, growth, and growth, then do we have the architecture for finance to do its part in fostering and engendering that growth in the real economy? Do we have the regulatory architecture to be able to do that? Is it consistent with growth objectives? And if not, what needs to be done? What can be done? So we have our distinguished panel here, and I will invite them to make their opening remarks one by one. And as they do, just before they do, I will introduce them. And I think we should start with Kevin, mainly because he is the instigator of this event, rightly so, and he's given us the umbrella topic as to why this is a discussion that we need to have, particularly here at the Systemic Risk Center. Kevin James is an economist, and he's a co-investigator at the Systemic Risk Center. His research focuses on the relationship between financial markets and the real economy, impact on fund management, corporate finance, that sort of stuff. He's previously worked with the FCA, the Center for Central Banking Studies at the Bank of England, the FSA, the SEC. So I guess we could think of you as an insider-outsider. And Kevin has a PhD in economics from UCLA. So Kevin, welcome, and your opening remarks, please.
Thank you. Hello. So as Lutfey was just saying, growth is definitely the main priority for this government, and that's the right goal, because continued low TFP growth in the UK will undoubtedly end up creating an economic, political, and social catastrophe, 10 or 20 years down the line. So the growth problem is really, may not seem particularly urgent, like, today or tomorrow, right? But over the medium term, this is maybe one of the most important policy challenges facing the UK and the government. So it's good that the government is focusing upon it and trying to do something, for sure. However, increasing growth is a real challenge, because rounding up the usual suspects is just not going to work. So you're thinking the standard things that governments do to promote growth is like, spend more money on infrastructure or whatever, that sort of stuff, or maybe do some sort of R&D tax credit, right? So those two things, so government spending on, or government investment as they tend to call it, and R&D spending somehow are the usual tools that governments use to promote growth. But in fact, there's actually no relationship whatsoever between government spending and growth. So this idea that government investment promotes growth is just delusional. It may have other benefits. Obviously, I'm not saying government spending is all bad, right? But growth isn't one of those benefits. Whatever you think about growth, government spending in general. And there's been a lot of research recently showing that R&D spending, is just losing its bang for buck, right? It doesn't really do very much to promote TFP growth anymore. So if you look at the US, which has a very long time series of R&D and TFP growth data, you can see that there's essentially no correlation between growth and R&D spending. Partially that may be because R&D spending is becoming less efficient at promoting growth over time, or maybe not, but that's like one possible argument. But even if that's correct, it means that just cranking the R&D handle isn't really going to get us very far, and it's going to cost a lot of money, right? So the UK spends about £40 billion a year on R&D now. The government aims to increase that by 50%, which is like £20 billion a year, and that's a lot of money. So relative to some of the other things we'll be talking about here, which are like reforming financial market regulation or improving financial markets in various ways, right? That's definitely like cheap. It's not going to cost £20 billion a year to do the sort of things I'm planning or the sort of things other people are talking about, right? And so the government can do, so even though I'm not going to, I would say that what the government's planning is not, so increasing spending and R&D spending is not really going to do very much, okay? But you can do all that too, right? And you can also do all the stuff we're going to be talking about for roughly the same amount of money. Right? Okay, so these ideas are likely to be like more effective and more cost efficient. Okay, so so what are these things I'm going to do? What am I going to suggest? So I've done some recent research with Akshay Kotak and Dmitry Chmokos. Akshay is here at the Systemic Risk Center, and Dmitry is a professor at Oxford. Um, our research suggests that effective financial markets can do a lot to improve TFP growth. In a nutshell, what happens is when markets work well, firms can get buy-in they need from other stakeholders to pursue long horizon projects that promote innovation. When markets work poorly, instead, firms have to pursue quick win, short horizon projects that don't take any kind of outside buy-in, but which also don't really do much to promote innovation. Right? So financial market effectiveness doesn't change the amount of R&D spending maybe, but does change the type of spending that firms do or the type of projects firms pursue. Right? So there's not any sort of direct, addition to R&D spending or addition to the firm's sort of potential. It changes the incentives of firms to engage in different types of projects. And it's by changing the incentives that firms pursue is how financial markets really have a profound impact upon the overall economic performance of the country, and particularly on TFP growth. Right. And so, we devised a measure of financial market effectiveness in our paper and our research, and we show that the decline of U.S. TFP growth starting in the 1970s could actually be due to declines in financial market effectiveness. Right. So because it's sort of the big mystery what's going on with U.S. TFP growth, so we think that financial markets play a key role in explaining this decline and why that decline has persisted for so long. Okay. So so what would you actually do to fix that? So happily, the Truss government, in addition to thinking about growth, is also thinking seriously about financial market reform, right? And so which I think is definitely the key to getting the UK growth moving. Okay. The problem is that fixing it's going to take a lot more to sort of improve financial market effectiveness than just give the FCA or the Bank of England an objective to promote growth. Right? So just changing their objectives by a little bit is really not going to do the trick. It's going to take much more fundamental reform of the regulatory system to sort of give that new kind of directive kind of meaning and power that really influence the way the regulators operate and so how the markets function. The core issue here is that there's no regulator in the UK that actually has a market effectiveness mandate or a market effectiveness, or a market effectiveness, goal. Right? And to actually pursue that goal effectively, you need kind of a mandate that says promote growth, right? But you also need the powers you need, the right approach, and the right capabilities. So just as in 2000, before the financial crisis, there was no regulator in the UK that had a mandate to pursue financial stability or an ability to pursue financial stability. There was this financial stability underlap, whereas the Bank of England kind of had this overarching financial stability duty, but didn't have any powers, and the sort of financial market regulators had some of the powers, but they didn't really have a mandate to look at financial stability as a whole. You had this sort of problem where nobody in the UK was focusing on the stability of the system as a whole, and so the crisis happened and nobody knew it was coming. Right? So now we have the same problem on market effectiveness. The Bank of England doesn't have a mandate or the powers required to pursue financial market effectiveness. Right? So its mandate is very much on monetary policy and financial stability, and those are quite different than market effectiveness. And so the powers it has pertain to its sort of more narrow mandate and not to this. So they can't really. So you can't just give the Bank of England an effectiveness agenda and say go do something, because they don't really have the powers to do that. Now they do have. What the Bank of England does have is kind of the right perspective on this problem. They think about the financial system as a whole because of their work with financial stability. They also have very deep analytical and research capabilities required to understand how the system works. Right? So in that sense, that's definitely a good thing. I'll come back to that later. Right? But as a package, the Bank of England isn't in a position to pursue market effectiveness now. The FCA kind of has the opposite problem. So the FCA kind of has the right mandate to pursue market effectiveness. Their objective is kind of broadly to make markets work well, even though operationally that's not what they do. But that's kind of at least broadly what they're supposed to do. Okay? And they have a lot of powers over how financial markets work through their conduct regulation. So potentially they could actually do something here. But the problem is with the FCA is that they don't have the right approach. They definitely don't have the right capabilities to pursue effectiveness as they're structured now. So what the FCA tends to focus on now is risk to the status quo, right? So they have, you have these markets as they are, and you say, is there some problem happening? Is like somebody getting ripped off? Or like, for example, my favorite example of waste of resources, is they spend a lot of time looking at the effectiveness of the prepaid funeral plan market, in the north of England, right? Then more people working on that than on financial market effectiveness, right? Okay, and so that was like a big thing for the FCA because they focused on conduct and they focused on problems that get in the newspapers especially. So if somebody's getting ripped off on their prepaid funeral plans, right? For the FCA, that's like a big issue, right? Okay, and so you identify these problems and then you try and fix the problems. And that's sort of like basically how the FCA operates. They look at sort of markets one at a time. So you look at market X or you look at market Y, okay, and you try and say, is there some problem here we need to fix? But the problem isn't like any one market. The problem is the whole system as a whole isn't anywhere near as effective as it should be. Right? It says the system doesn't work is the problem. Right? It's not that there's like these little defects here or there. Right? So if all you do is look at kind of problems of the status quo, you never even see that the markets as a whole could be a lot better than they are. Right? And that's what you really need to do to improve financial market effectiveness. Right? Okay, and so to do that,
I'm very tempted to stop you on the cliffhanger.
Oh, no, okay, 1 second. Okay, so 1 second. Okay, so there's one more thing. Okay, so basically what you need to do is combine kind of the best parts of the FCA and the Bank of England, right? So you need to have the sort of FCA's kind of mandate and powers, right? But you need kind of the system-wide approach and sort of deep analytical capabilities that the Bank of England has to actually pursue this task properly. So that's going to be hard. That's a big reform, right? So trying to transform the way the FCA works is going to be important. But if the government doesn't actually do that, then they're not going to get the financial markets they need to promote their growth agenda. Thank you.
Thank you, Kevin. I'll come back to you with asking you for a little bit more elaboration on exactly what needs to be done or can be done. If we could now move to Charlotte. Charlotte Clark, CBE, is Director of Regulation at ABI, Association of British Insurers, with accountability for relations between the industry and the Bank of England on prudential regulations. She was previously with the civil service, where she worked on the financial service regulations at HMT and the DWP. Charlotte, over to you.
Many thanks. Is that working?
Isn't working. I can't tell. Would you like to use this?
Okay, thank you. I'll put that on there. Do you want that? So I guess I'm the practitioner on the kind of panel in terms of, so at the moment, as I said, I lead the kind of relationship between the insurance industry and the regulators, which certainly has its moments at the moment, with lots of discussions about reforming Solvency II, which is the prudential regulation for insurers, as well as lots of discussion around conduct issues. So big changes to the way general insurance pricing has happened, future plans from the FCA in terms of where they're going on conduct issues around the consumer duty. But my background, as Lutfey says, is on the other side of the fence of actually writing a lot of regulation. From both the Treasury perspective and from DWP, a lot of my career has been kind of imposing regulation and solving problems rather than necessarily where I stand now, which is telling the regulators what they do wrong. I think that's basically my job description. They would certainly tell you that was my job description. But that said, I think, when you're on the financial services side, people's assumption around financial regulation is that I would sit here and tell you that what we want is a bonfire of regulation and that, a kind of deregulatory approach is the right way forward. That is not what I would argue for. If I think about what makes London a successful financial services sector, what makes the UK a successful financial services sector, good regulation is right at the heart of it. So if you care about growth, you care about good regulation. If you think about the successful financial services sectors, they have strong regulators. They don't have weak regulators. They have regulators that are respected. They have areas where people know that if they come and do business, the regulator knows what they're doing. There is stability. There is security. And I guess ultimately, that's a lot of the purpose of regulation, is ensuring that people can make decisions. So whether that is in terms of people wanting to save for their pensions, in the long term, you don't want to put your money with an insurer who isn't going to be there when you retire. So actually, it's, if you want people to save, you've got to have security within the system. Similarly, if you want businesses to flourish, how they manage risk. I mean, the whole, the history of the insurance sector is an interesting one, and at times a very checkered one, let's be honest. But, where a lot of the insurance companies started was kind of post-Fire of London, of insuring businesses so that they could actually invest in premises and not worry if there was another fire. So how do you actually, at the moment, the risks not the same, but if you think about things like cyber risk for businesses, if you think about business interruption, if there is a pandemic, these are big risks that will affect businesses, and if they're not able to insure themselves and they're not able to get access to those sorts of kind of financial products, then it's very difficult, I think, for businesses to flourish. That said, of course, I wouldn't be doing my job if I didn't tell you that actually an awful lot of the regulation that is around, the kind of post-Brexit kind of review of financial regulation is really interesting. Because we were discussing before, basically all of our financial services regulation has come from Europe. Since the single market, everything that's on the books at the moment has come via Europe. And who was the preeminent voice in financial services regulation discussions in Europe? It was the UK. So much of what we've got was from Europe, but so much of it was actually designed, written in London. So the idea that we would somehow want to start changing all these things or radically changing these things is just not true. That said, if I take something like insurance, where we're talking about Solvency II, we are reviewing Solvency II post-Brexit, but the EU are also doing it. So the EU are also undergoing a review of Solvency II, partly because it's been in for like 5 or 6 years now, and you can kind of see some of the problems and some of the things that we got wrong. So there's that bit. That said, there is a UK perspective, which is, actually the UK insurance market is very different from the continental insurance market, where general insurance predominates, whereas in the UK, essentially, it is life insurers, it's the pensioners that dominates. And, making sure that it actually works for the UK is what we're looking at. So one of the things that we're really kind of focusing on is, so when the review of Solvency II came through, the government gave 3 objectives. One was a vibrant industry, which I'm never sure what that means, but it'd be great. The second one was kind of policyholder protection. You can't undermine policyholder protection, which is stating the obvious, it seems to me. I mean, what's the point of having an insurance company if you're not there to pay out? And then the third one, which is the one where a lot of focus is, and it kind of links to a lot of things that Kevin's talking about, is around investment. So what can insurers invest in? And, and when can they invest in different things? And I think that this is broadly, it feels to me, the key to growth, is how do you use the money? So, the amount of money is extraordinary. In insurance alone, there's 2 trillion. So what's that? Almost 100% of GDP now. In defined benefit pensions, which is another big sector, there's another 2 trillion. So, if you can unlock these assets and use them, which is where the government, but it's where every government comes from. If you can use these assets in the right way to pay for the things that you care about, then, that's the kind of nirvana. If it was easy, it would have been done by now. So how do you ensure that you get the right regulation, the right protection, at the same time as ensuring that you're investing in the real economy rather than necessarily in kind of equities? You're going to stop me, aren't you? Can I make one more point? So I mean, that's kind of insurance regulation. I mean, the other big thing that's going on at the moment is the Financial Services and Markets Bill. So post-Brexit, what is the structure by which financial regulation is made? So, I mean, it used to be like Solvency II, I mean, it was like 10 years of people's lives going on the train to Brussels and discussing these things. And, you know, it was a long time to get regulation done. And so the language now post-Brexit is we can be agile, we can be quicker, we can be, you know, we can be more responsive and reactive, which would be great. You know, it's hard to argue against those things. That said, scrutiny is incredibly important. And how that structure works. So you know, we've mentioned already giving the regulators new objectives around economic growth is one of the things that we've been arguing for. Not for it in itself so much, but more, and I guess this kind of links to some of Kevin's points, more about changing culture. I should say some of my best friends work at the Bank of England, but it is a peculiar organization. You know, the FCA, again, is it's a very unusual organization, and I have a lot of sympathy in terms of some of the things that you know, all of their failures are incredibly public, you know, and all of their successes are incredibly private. You know, you look at something like funeral plans, I can't remember, some ridiculous number of how many are actually sold. When I say ridiculous, ridiculously small, we're talking about like maybe 50, 100,000 that are sold across the whole of the country, which is nothing in the grand scale of financial services. But you look at how many articles there are about funeral plans in the Daily Mail money pages, you would think it was the biggest scandal possibly going. You know, so how do you run a regulator when you're trying to deal with those things? I will stop there.
That is a great point to stop on, and I can already see a link between what you said about the 2 trillion plus 2 trillion that could be unlocked and released, and what Kevin said about how effective markets can unleash a type of long horizon projects, both of which then can power growth. So let's come now to Eva. Eva Micheler is professor in law at LSE Law School and a co-investigator at the Systemic Risk Center. She's also a professor at the University of Economics in Vienna, and she was a fellow at the Faculty of Law in Oxford, regularly teaches in Hamburg, and her recent book was published with Oxford University Press and is entitled Company Law, A Real Entity Theory. Eva, over to you.
Yeah, so thank you very much. So I'm going to provide some legal context to this reform project to integrate growth, and then I'm going to make a point of my own. So the context first. At the moment, the regulators have objectives, and those objectives are, for the Financial Conduct Authority, it's protect consumers, enhance market integrity, and promote competition. The PRA then has the objective of financial stability. So that is the status quo of the objectives of the regulators. And from a legal perspective, those are important because they provide limits within which regulators can act. So if they can only act with a view to promoting these objectives. Now, the current change or reform is about adding 2 objectives to those objectives. So the objectives are, and we now know it's going to be a secondary objective, which is below the existing ones. And those are promoting long-term growth, the topic today, and enhancing international competitiveness. So that's sort of the legal context here. Now, the first thing is I'm connecting here to Charlotte to say all the financial services rules are very much EU rules, but they have been substantially influenced, perhaps you could even say altogether written, by UK-based civil servants. And I was at a conference on Tuesday in Vienna. It was an international financial regulation context, and I spoke to a number of people that told me how much they miss the British civil servants because they now need to do their own drafting, and it's quite a learning curve for them. So there's a lot of UK-centered regulation in the EU. Having said that, those rules were, of course, written with the single market in mind. So they have been written with the objective of creating a level playing field for a large number of countries. And And that objective has fallen away. So it makes sense to look at the rules again and to say, does this make sense for the UK outside of the EU? And then there is a sort of, there's the idea of adding some objectives, and also the idea of who is now making the rules within the UK. So we are onshoring the competency and responsibility for rulemaking, and that will go to the regulators and will be overseen by the Treasury and by Parliament. And there's an ongoing debate on how we're going to do this. Okay, now then there is a debate about what about these new secondary objectives? And there is a risk, of course, if we focus on international competitiveness, there is a risk to go for short-term gains and decide to drop the quality of the regulatory regime. And Charlotte has just said that that's not a good idea, because in the long term, a market does best with high-quality rules. There's a second problem with integrating goals that have to do with economic growth or international competitiveness, and that is you begin to politicize the regulator. The regulator then becomes involved in general public policy and in a political discussion about what is good for growth. And that is something that's hard to do for a regulator. So there's a big question of how much of this do you want at the level of the regulators. And we see this in relation to ESG, where sort of we are looking at, we're paying attention to what do businesses do about ESG, where in fact this is a political discussion. So there is a question there that this then undermines our desire to have an independent regulator. And independence is an important thing. Regulators are only as good as they are independent. So if we throw them in the political space, it's a big question of how are they going to remain independent when their decisions are overseen by the government. Now, so that's sort of context, and then the point I would like to make. The point I would like to make is that what we see in how regulation is made, there are objectives, but there's also a phenomenon that I think we should be very aware of, and that's regulatory capture. And I'm here talking about how the government goes about making rules. And the normal process for this is to say, here is a problem, and a co-author of mine who is here, Elena, and I are working on the rules that govern the way securities are held. And in that space, we have a long-standing issue, and the issue is that investors are not very well connected to issuers. So the financial services intermediaries that work in custody don't provide a service that allows investors to exercise their rights. It's a well-documented issue. It's an issue that the Law Commission has written about several times. The BIS, when it was the BAYS, when it was the BIS, wrote and acknowledged this as well. And so what happens in this space, and you find this in many areas, is the government says, here's a problem, and calls for evidence, and then discusses the problem, and then makes suggestions on how to solve it, and then this goes into consultation. And at this point, all the incumbent service providers make representations, and those representations are very much in line with their existing business models. So there's nothing other they can do. Their shareholders and owners would be very upset if they did anything that undermined the source of their revenue. So we're finding a very active contributions from people who are incumbent service providers. And then the mistake that is made time and time again by the government is then to look at these responses and quantify them. So you have a government response that says the majority of our respondents said this. And they amplify the voice of existing market participants. This is something that Andrew Bailey, when he was at the FCA, the executive director of the FCA, acknowledged. He said, international competitiveness as an objective must not be something that entrenches the business models of existing providers. So there's a very big issue in lawmaking in that the regulators seem to find it very difficult to think about who has made which representations and to kind of overlook numbers and say everyone here has an entrenched business model. Investors come first. We therefore will proceed with a change. So there is a problem in talking about we are promoting growth in the financial services industry or in the economy in general, doing this in a way that doesn't entrench the existing market participants. So that's an issue I think that we should be very aware of.
Thank you very much. You ended before I had a chance to prompt you. I do have some questions for you, but I'll come to those in a moment. Now, before we go to John Daníelsson, I just wanted to get a sense of how interactive people would like this to be. Do you already have questions, burning questions that you want to ask the panelists? Yes? Yes, cool, all right. So a reminder, this is being recorded and it's probably going to be posted online. So I just have a duty to let you know. John Daníelsson is co-director of the Systemic Risk Center, together with JP Zikran sitting over there. He's also a reader in finance at MSc and research interests apart from systemic risk and financial risk and econometrics. His latest book is The Illusion of Control: Why Financial Crises Happen and What We Can and Cannot Do About It. And John will probably now tell us that everything everyone else said is all wrong. So, John, over to you, sir.
Thank you so much, Lutfey, for this kind introduction. Looking at the topic today, which Kevin was quite well chosen by Kevin, financial regulation, because now that we have left the European Union, that does provide opportunities. Whether the government chooses to take them up is a different matter, but I want to discuss some of the opportunities that being outside of the EU can give this country in terms of economic growth. And let's start with the question, what is the objective of financial regulations? And not on the level Eva was talking about, which is on the level of what the regulator should think about, but how should the government think about regulations? And I think there can only be one objective for regulations. That is to maximize economic growth, subject to not having too many costly crises, too much abuse, and environmental and social objectives. It is growth conditional on other things. And the thing is that if the regulator is the only entity to talk about regulations, they only focus on the constraints, not on the objective. And of course, from basic finance theory, there's a direct relationship between risk and growth. The riskier we make the system, the more the economy grows. So therefore, if the government is going for growth, the government is also going for risk. You cannot separate those two things out. Now, however, there is a risk and growth trade-off, but is there a regulation and growth trade-off? And that is something I don't really see. So therefore, we can achieve, so I'm going to make the case here that we can get more growth with a more stable financial system by changing regulations. And though the opportunities to do so are presented by not being in the European Union. Now, let's start with what risk is. Well, we tend to think that risk is something measurable. That is, someone can just say the temperature in this room is 22 degrees. If it goes down, you turn up the thermostat. We might think it works the other way, but this is LSC, and we are not allowed to have AC. So we can only meet the target from one direction, but in a normal working place, you do it from both directions. Now, there's a feedback between measurement and the objective, and that is simply not true for several reasons. First of all, you can't really accurately, we can't even at all measure the type of risk we care about. If you look at the way almost everybody, the financial authorities and the financial industry measures risk. They measure the risk of day-to-day frequent events. How likely is it that the stock market will go down by 5% or the yields on gilts go up by 20 basis points? So a lot of observations. We throw that into our statistical apparatus. Outcomes, a distribution of outcomes. And then we say, by magic, we can then use that distribution to project onto the risk of extreme events, 150 basis points event like we had last week, or a 20% drop in the stock market. However, there's no data. If you don't have data, you cannot make a statistical statement. I think it's impossible, technically, to provide a measurement of systemic risk or extreme outcomes. And therefore, if the regulator tries to target that, they are just targeting a number that is as accurate as if you had typed into Excel RAND, open close parenthesis. You're not going to do any better than that. Secondly, not only is the type of risk we care about not measurable, but also what risk is ill-defined. What risk is to me is different to what risk is to Eva. It is different to what it is to my parents, and it's different than it is to my students. Risk to an insurance company is different to risk to a bank, and different to a high-frequency trade or different to a pension fund. And the risk to one bank is different to the risk of another bank. However, if you want to control the system by risk, which is exactly what almost the entire regulatory apparatus is trying to do, what you end up with is you're trying to shoehorn risk into one or two or a small set of measurable things. So you end up targeting the wrong type of risk, even presuming you could measure it, which is certainly not true. And finally, this term prudential, as in the prudential regulatory authority. Of course, we're all supposed to be prudential, but let me discuss the downside to prudentiality from a financial stability point of view. Suppose the authorities are successful in making everybody prudential, everybody's proper. Then a shock comes. Perhaps Russia invades Ukraine, or perhaps COVID comes, or Liz Truss becomes prime minister. Some shock comes. What is a prudential financial institution to do? They have to sell these risky assets. But they're all prudential, so they all have to sell at the same time. And what happens to the market price of those assets? It goes down and down, and because it goes down, the prices go down more, and therefore you sell more. It's a vicious feedback loop of exactly the type we saw on Wednesday last week. So the Wednesday last week is a textbook example of the type of fire sale we see in every single crisis, and which prudentiality in regulations encourages. So, therefore, when I said earlier, there is not necessarily a trade-off between regulations and growth, that's what I meant. So how can we regulate effectively and still get economic growth? I think it is surprisingly simple. What we need is for the institutions of the financial system to be as different from each other as possible. We need diversity, not in human beings, we need diversity in the types of institutions we have. What does that bring us? That means a few things. If a shock happens, somebody will buy, somebody will sell, therefore the shock is dampened out. Another name for this is shock absorption. So instead of thinking of buffers, and buffers are very costly because who pays for the buffers? It's the clients, i.e. we pay for buffers with growth. The more capital is, the more protection buffers you have, the lower growth is. So if you increase shock absorption, you can lower the buffer and you get more growth. That's the first way you get growth. Then we continue because the clients now get access to better financial services, more tailored to them, that are cheaper. The investors get more return on their investments, and the borrowers or the companies can borrow cheaper than all of us could do with more tailored investments to them. That also helps growth. And finally, that also means we get more stability. So we kill two birds with one stone. You get more economic growth, and you get more stability. Now, what gets in the way of that? Well, regulations. Because the regulators, I think, are decidedly anti-diversity in terms of the types of institutions they allow. If you know of anybody who's trying to get a license to operate in this country, you know how devilishly difficult that is. And I know a few people who tried and had very good business models. Now, why is that? Of course, the problem is the incentive structure of regulators is completely wrong. Exactly as both Charlotte and Eva said, the regulators get pillared when something goes wrong, but they do not get rewarded when things go well. It's a really good example in air traffic. In airspace in Europe, the space between aircraft is 1.8 miles. In China, it is 5 miles. Now, why is that? Because in China, if an air traffic controller makes a mistake, he or she is punished. If air traffic flows, they get nothing. In Europe, if air traffic flows, they get a bonus, and if they make a mistake and report it, they also get a bonus. The name for this is risk culture. We do not have a risk culture in financial regulations. We do have it in air traffic control and other spaces of the regulatory domain. And if we adopt such practices, I think we will get much more growth and much more stability. Now, and finally, to come back to the EU needs to, because of the diversity of the countries, to have level playing fields and apply same rules to everybody for very obvious economic and political reasons. Well, we do not need to do that in this country. So things like CRD, which is the European capital regulations, we can, if we dispense with that, we have a much more scope for having different treatments for types of institutions we have. So therefore, if the government wants to go for growth and more stability, I think the way to do that is to impose on the regulators the requirement that they do their level best to diversify the types of institutions we have. And with that, I think I probably overextended my welcome, Lutfey.
No, that's great. Thank you. So now we have all of you having set your stalls, and I have a question for each one of you. So I'll ask them one question each, and then the idea is to open it up. We have all the way until, I believe, 7:30, so plenty of time. Please have your questions ready. Kevin, let me come back to you with a question about the how of what you said, which is that market effectiveness as a mandate, as a goal, doesn't seem to exist or doesn't seem to be practiced by any regulatory authority right now. Specifically, what needs to happen to get us to that outcome?
So I guess I was following on from what Eva was saying. So you don't want to give regulators a growth objective because that raises all these issues about about all the political issues that Eva was talking about. But the government should sort of realize that market effectiveness promotes growth, or it's also working with John's ideas on potential regulation, and set the mandate for that.
You mentioned you have a measure for market effectiveness. What goes into it? Just give us a feel for what defines it.
So it's based on the standard. So it's the standard deviation of idiosyncratic returns for individual firms. So it's sort of like when markets work well, firms pursue longer horizon projects, and they produce less kind of information on the day-to-day basis, and so there's less bouncing around of stock prices. That's basically it. So when firms pursue these very short horizon projects, then the stock price bounces around all the time. That's the intuition. So roughly, okay. And so so to promote this sort of better culture and regulators, this different approach. First off, so you don't want to give them a growth agenda, or certainly not a competitiveness agenda, which has an objective, which has all kinds of potential negative effects. You want to make them say you want markets to work well is the key thing, okay? And then you need to give them the sort of analytical and research capabilities they need to pursue that, which said the FCA doesn't have now. So that's why it should be. So you want to, it says transform it to be more like a central bank, basically. Okay. And so one thing that would do is that if they have a system-wide perspective, then they can think about how different parts of the market kind of work together. Because an example of how we don't do that now is you think about sort of asset management and corporate governance, right? So asset management rules sort of are like, investor protection, that sort of thing, right? That's done by one part. And then corporate governance is like, how do shareholders affect the way the corporation runs. But the asset management rules determine who owns the shares, right? And then the corporate governance is influenced by who owns the shares, obviously, because those are the shareholders who are directing the firm, right? Okay, so your asset management rules really affect corporate governance through their impact on ownership structure, right? And so, so if you don't think about those two things at the same time, you're not going to get to the right kind of either the right level of investor protection or the right level of corporate governance, because those two things are obviously deeply and fundamentally connected, right? So as you think of these things one at a time, right, and you think about them not even one at a time, even worse than that, you think about like, oh, here's some little problem in asset management, and here's some little problem in corporate governance. We'll have a rule to fix this little thing or that little thing, right? You never think about systemically how you should get this whole market to work together in an integrated, efficient style. So if you have, but obviously that takes a lot of analytical and research work, because you can't just do that by winging it, right? You need to really understand kind of what's going on, right? And so
the mandate issue, capability issue,
it's
or
both.
culture?
So the mandate is mostly a culture issue and a capability issue, right? And so I think so if you can fix those things, then you can start thinking more systematically and more deeper about how the markets work. So I guess that would be the key thing. So and that's why it's going to be a big change. It's not something you can easily do by just changing the mandate, because the culture and the capabilities aren't there. Okay, and so to really get the change you want, then you need to change all those things, which would be said a lot of work.
Thank you. So, Charlotte, I was quite taken by, a little surprised by your point that you're not about deregulation or low regulation. We have a fairly simplistic mapping between the lower the regulation, the higher the growth. Should it not be a race to the bottom? Crypto exchanges are shopping around country to country. Whoever will host us, we will come to you. How does it actually work in practice? Is it, how do you maintain, isn't the post-Brexit strategy all about undercutting EU regulation?
I think asking me what the post-Brexit strategy is a devious question. So I think if you look where financial services flourish, it is in areas of stability. It is in areas where there is strong regulators. So whilst, if you look at cryptos, I'm no expert on crypto. I mean, who is? But the idea that somehow that is driving growth, okay, I would question that. In terms of what is actually driving growth, unfortunately, I think this is probably slightly unfortunate for anyone who wants to achieve growth in 18 months to 2 years' time, is, the problems of growth within this country are much more systemic. So actually, in terms of how you think about productivity, how you think about investment, those are the things that ultimately drive growth. And that is ultimately, I think, about long-term decisions. It's not about short-term ones. I would agree with Kevin. So, it's about how do you set up regulation to do that. One of the buzz phrases at the moment is patient capital. And that basically is, what it says on the tin. It's not about short-term returns. It is about long-term investment to be able to receive long-term returns. And, that feels to me to be the area where, that's where successful economies are focused. It is in these long-term infrastructure issues. It's about fixing the things, whether it's the energy system or whether it is, we haven't really talked about ESG and net zero, but if you think about one of the things that London is focusing on is about being the preeminent place for regulation when it comes to green finance. So how do you ensure that you've got the right system? That is not deregulatory. That is re-regulatory. Well, I guess it depends where growth is going to come from. I mean, if you think growth, let's think about growth industries at the moment. I mean, well, if you're a wind farm producer, my guess is you're probably having quite a good year. I'm going to guess, it would probably best not to get into oil and gas, but, they're having a very good year, but for very unusual reasons. If you think about where areas for growth are likely to be, I mean, they're not about 1-2 years. I mean, they are about long-term investment. I think it's a slightly kind of outdated view that deregulation is what drives growth.
Thank you. Eva, your point about capture by incumbents through the consultation process, I think I can relate to. I mean, if you look at in spite of a decade or so of technology disruptions, fintech, all of that, we don't really have the equivalent of an Amazon or a Tesla in the financial services industry. It's the same players that seem to have remained entrenched. Or the fee structure in asset management has completely remained unchanged over this decade. What can be done? What's the way to change this? How do we get more dynamism? Because presumably, in order to get the total factor productivity that Kevin talks about, you need dynamism, you need companies and business models to die and new ones to arrive. How do we get that?
I think what's really key to achieve this is regulatory independence. I think that's a really important aspect of enabling the regulator to step back and say, we're not interested in sort of writing forward the business models of incumbents. And there the trouble is, however, Charlotte just mentioned that the time frame within which the current government needs to achieve their growth objective is 18 months to 2 years, because that's how long it takes to the next election. Then the idea that anything they do now will be structurally sufficient to achieve long-term growth is very optimistic. It's more likely that what they are going to achieve is a short-term, if anything, a short-term growth of in some way, shape or form. But that is definitely going to be existing providers writing forward what they've been doing. So I think independence of the regulator and an awareness that the consultation process shouldn't be the returns to consultations shouldn't be approached on a quantitative basis, saying, here's what the majority of our respondents have said. And they should just be thinking about, okay, so here is what the existing market providers have said, this is what the challengers have said, and here is what consumer organizations have said. I think there's a sort of, and maybe that can be done by, writing it into the policies that the civil service uses when they draft legislation, when they use consultations.
Thank you. John, does your mic work or do I need to? Okay. So Eva, I mean, as you were speaking, I was thinking the time horizon of a British Prime Minister is getting shorter and shorter. It's not certainly not getting longer. We used to say that certain things need to be done by government because the private sector has a short time horizon. That may have flipped. John, I have two issues with your diversity argument. One, isn't there a fairness or equity problem in saying that I'm going to regulate one institution one way and another one differently, using the RAND function on a spreadsheet to decide who gets regulated how? So how do we deal with that? And then secondly, when you said with Brexit we now have a scope to be different and to treat institutions differently, isn't that just another way of saying let's undercut the EU and let's join the race to the bottom?
No and no. No. You want me to elaborate or just... Okay, so if I go by your logic, Lutfey, you want to treat everybody the same, you have to regulate everybody like HSBC. Now, HSBC has an enormously high fixed cost in regulations, and nobody who is much smaller than HSBC could meet the cost of being regulated like HSBC. So if you go by that argument, you will only end up with the very largest banks, and you end up with a race to one humongously large banks, because in economics it's called increasing returns to scale. And if you treat everybody the same, you're also encouraging increasing returns to scale, which we know is a horrible thing to. So therefore, and we do it all over the place. I mean, if someone is involved in some type of activity, we monitor them for that activity. If they're not doing something else, what's the point of monitoring them there? So therefore, if some financial startup chooses to allow financial intermediation on the Ethereum blockchain, which the FCA has granted licenses for, by the way, if you choose to do so, there is no need to impose on the regulations that apply to other types of financial institutions. So we can tailor them to the activity they are doing. And that's the first thing. And however, when it comes to Brexit, I am not advocating what is sometimes said, we should just burn all regulations, and I think exactly for the reasons we've heard here today. Most of these regulations we have in the EU were written here in London anyways. And knowing British history, we do like regulations in this country. I mean, this is not a naturally libertarian island, even though some people might think it is. However, we do have a history, if you go far enough, of intelligent regulations. So the question is, because the EU has particular constraints imposed on it by the heterogeneity or diversity in countries they have countries that are very poor and very rich. How do you regulate Bulgaria and Luxembourg with the same type of regulations? I mean, it's not an easy task. So that imposes constraints on the EU we simply don't have in this country. So therefore, what I'm saying is there's no race to the bottom, but we don't have to be constrained by something EU needs to be constrained by.
Okay, so now we're ready for members of the audience. I know you have a question to ask. Can I get a sense of, are there others? 2, 3, 4, okay. Good. Let me pass the microphone around.
Thank you. As Professor John rightly said, that risk differs from person to person. So the risk of a hedge fund is different from the risk of a pension fund, which mostly manages the long-term savings, especially the retirement savings. So should the regulators be allowing accounting strategies like mark-to-market or more leverage in the pension fund, especially now we are seeing linking a very fancy acronym called LDI, that is a liability-driven investment, which seems to have created some kind of disaster with its, there is a leverage also, right? So, as Buffett rightly said that financial derivatives are the financial instruments of mass destruction. Should we be allowing leverage and derivative strategies, especially for pension funds?
Yes.
Oh.
I'll elaborate.
Then we are inviting more crisis.
There is nothing inherently wrong with derivatives. They're a very useful hedging strategy. And like almost every other human creation, can be used for bad or for good. Some people misuse them, and the regulators can then set guidelines as to who can use derivatives in bad ways or good ways. But there's nothing inherently wrong with them. But of course, they can be abused, and of course, pension funds should not be allowed to take excessively risky strategies that are vulnerable to margin calls. And I sort of do wonder who was overseeing them in this particular case, because while a 150 basis point increase in the gilt yield might be unusual, it is not out of the realm of possibility, and it should have been stress tested, and somebody did not stress test that, and who failed? Somebody in the regulatory agency.
I would give it differently. So leaving aside, we can talk about LDI, but what's the risk for somebody in terms of saving for their pension? You know, actually the biggest risk is, and this is where there's a big difference, isn't it, between risk and uncertainty and, you know, variance. You know, if I'm investing my pension, and actually I'm investing in something which provides 3-4% a year, then actually the risk is my pension income, particularly if I don't need it for the next, I'm obviously very young, so, you know, I don't need it for the next 20 years or so. You know, so it's about how do you ensure that the time horizon over which you're investing is right and that you're getting the best return for that. Because, you know, I think all too often regulation is focused on volatility rather than actually the risk. If you are saving for a pension, the risk is that you don't get the pension at the end, or you don't get as much pension at the end because it's been invested poorly, because it's been invested in less risky assets rather than actually appropriately risky assets. On the LDI issue, I mean, you know, my background when I used to be director of private pensions in DWP, so I was responsible for the regulation of private pensions. To me, the problem last week is not with the pension funds. The pension funds are completely fine. What happened to them in terms of gilt rates actually made them better funded. You know, the problem is actually my understanding is that there's a regulation that requires cash to go from the person who has hedged to the person who requires it. Why they couldn't have sent the gilts, I do not know. Why the gilts had to be sold in order to you know, I get that the investors needed more money because the hedging had changed, but I have no understanding as to why that couldn't have been gilts rather than cash. And that's where I think, you know, some poor regulation has been put forward.
I think as the value of the gilts had changed.
Yeah.
So if you need $100 in collateral,
But it's because they had to sell them because you could only put cash in. So if there was a call on me to provide you with £100, why couldn't I just give you a £100 gilt rather than having to sell the £100 gilt in a market that was falling?
They seems to have borrowed more and then invested. They invested with borrowed money. They invested with borrowed money. When the bonds crashed, they need money to meet their margin calls. So they ran out of cash. So what they did is to raise the money, they were selling the bond which they are having. So that sales further pushed the prices down.
That's the investor. So it's not the pension fund that's
That investor is a pension fund.
No, it's not. It's the LDI investor. It's the LGIM. It's the BlackRock. It's not the pension fund that's doing it.
okay. So next question, please.
Robert McRae, SRC. Kevin, Charlotte, you both mentioned the need for patient capital. Back in 1990, I was working as an engineer for Marconi, one of Britain's premier technology companies, and I was made redundant because my project had a payback of more than 2 years, so I tend to agree. But is this really a regulatory issue? It's widely stated that in the US, private equity has been what's served this function, and that listed, highly regulated entities need not be involved. What do you think?
I think where this comes in is the idea that Charlotte mentioned this earlier. There are trillions of pounds patiently waiting to be used by the government for the growth agenda. And that is, I think that's also a current that is in this debate, that there are all these infrastructure projects that need funding, and there's a hope that the pension money could be made to work because it's a patient, you know, it could be patient capital funding these investments. And I think there's a real risk that the government, you know, becomes too long-fingered and uses my pension pot to fund their policy preferences in terms of infrastructure. And at that point, I would like the regulator to say, look, go away, find your own money, and leave the pensions in peace.
Thank you. There was a lady here who...
I can say, I can make one comment. On
Yeah,
that.
please.
If I can say, so I think that the the evidence suggests that private capital isn't a perfect substitute for public capital because TFP growth rates have remained, for the overall economy, have remained pretty dismally low, even as the share of private equity has gone up. Right. So I think there's still a problem there somehow. So I don't. So even though I see the argument that private equity in some sense is a way of dealing with this problem itself, it seems like it's not enough somehow. And so exactly why that is an interesting topic of research. I'm not sure what the answer is there. But I said overall, I think it hasn't just fulfilled that promise.
Your question.
Hi, my name is Hamsavani. So my question is about how inflation affects the topic today. So I noticed that it wasn't really mentioned by any of the speakers. So I really want to know what's the impact of inflation when governments want to go for growth, especially the UK government, especially the current high inflationary period, as well as the relationship between the government and the Bank of England in terms of setting interest rates and their sort of lax nature in increasing interest rates until recently.
John, would you like to take that?
I guess I have been volunteered. I think the quick answer is there is none. That is when we are discussing regulatory reform and the task for growth, the level of inflation is a very important topic, but it's a separate discussion to that. So that's my take. So I don't see a connection between those two things within the framework of the question we are discussing today.
In the other part of the cycle, though, when we saw quantitative easing and interest rates going to zero and negative, you had one part of the regulatory authority trying to boost growth by doing that, another part lifting capital requirements and maybe introducing more macro-pru.
Oh, there's a wonderful example from 4 years ago when one part of the Bank of England was complaining about excessive risk-taking and therefore wanted to raise capital, and then was complaining, another part says we need more risk and reduce the requirements. So the Bank of England said, with one part of the Bank of England, increase risk, another said reduce risk. Right. So perhaps there's different divisions, so should we maybe talk to each other?
One comment, if I can.
Question.
Yeah. So even though there isn't a direct connection between, I think, monetary policy and growth, as we were saying, it does have a connection in the sense that the Bank of England is responsible for both things. And so if in turbulent macroeconomic times, the senior manager of the bank is all consumed with sort of monetary policy issues, then they have less time to think about these other issues. So it's kind of a question of organizational design. How do you what responsibilities do you put in each different organization, given that people at the top have to make these decisions, and they just have a finite amount of time themselves. So, for example, one argument against sort of just giving the Bank of England also responsibility for financial market effectiveness is then you'd have the governor of the Bank of England would have to be an expert on monetary policy and prudential policy and also financial markets. And there's nobody in the world who could actually do that, right?
You'll find Andrew Bailey will tell you he could.
Yeah, okay, yeah, okay. In my view, right, and so that's a potential concern. I think that's the.
There is actually a slightly deeper take on this particular question, which is the fundamental objective of a central bank is monetary policy. And anything that undermines monetary policy is dangerous. And what we have been doing over the past 15 years, ever since the crisis in 2008, is because in some places the central bank is seen as the most competent institution of government. We are asking the central bank to do almost everything. At least in this country, we don't have the central bank doing environment, but in Europe, the ECB board is very, very much involved with environmental objectives in terms of regulations. And this mission creep is dangerous because and the fundamental problem is whether we have an environment or whether we have regulations or we have something else, these are inherently political objectives. And a political objective needs a mandate from the political authorities. So perversely, the more power you give to the central bank to do something, the less power it has, because you're giving power to the government. So therefore what we are seeing now with inflation is that because the Bank of England has so many hats, that it might find it difficult to properly deal with inflation, which it might have found it easier if it had a more narrow mandate.
Fewer objectives to deal with. It was a great question, as it turns out. Sir, over there, and then JP after that.
Thank you. Antti Suhonen, Aalto University. Very interesting conversation. I've got, I guess, two comments, and there might be a question therein. So Ms. Clark made a very good point about, or I think the point you made was that good regulation makes a good marketplace, makes a good environment for financial services. I think it's very important not to confuse more regulation with good regulation. And and there's, I think from a societal perspective, my experience is from the banking world. I started my career in the early 90s and have seen a lot of change in that field. Admittedly today, banks are probably safer than they have been in a very long time. Is the financial market overall safer? You look at the UK over the past couple of weeks, probably not. Why? Because we don't have that diversity of risk takers out there. So that's the first comment I would make. The second point is that if we go back to the why should we have regulation? Well, yes, there's protection of the consumer, there's market integrity, and then the third point, the way I would phrase it is that essentially, if the taxpayer is backstopping something, then you should regulate that activity. So the question is, should the taxpayer always be called in to bail out whichever is the present failing industry, or should we, in fact, take off the training wheels from some of the operators and say, well, sorry, you're on your own, and if the solution to that is, well, let's say banks should be running with 25% Tier 1 core capital, and then you go with much less regulation, should that be an alternative model? You can choose high regulation with less capital, or you have more equity, and that's the choice.
So if I take your questions in reverse order, or question or comment, whatever you want to call it, I think that's exactly the point I make, because if we only have systemically important financial institutions, SIFIs, we have to bail them out, because if they fail, it will be catastrophic, which I think is exactly the type of discussion they have in Switzerland at the moment. Now, if, however, and that means you give them super high buffers, which make the provision of financial services really expensive. If you have smaller, much smaller financial institutions, you don't care if they fail. Therefore, they need less buffers. You get cheaper financial services, and if they fail, they fail. And I think in a slightly different context, the reason why the United States recovered so well after 2008 is that this entire size of the US banking system is 95% of GDP. The size of the British banking system is 3.5 times GDP. The same applies to the rest of the world. And the fact the US banks are so small, the US authorities could afford to be tougher and let them recover faster, which is why in the year 2022, the American banks are more dominant than they had been in 2 generations. So precisely because they are small relative to the economy. So therefore, my diversity argument goes exactly in that direction. On your first question, are we safer? Now, I wrote a blog piece over the weekend arguing that systemic risk is higher now than it was in 2008. Ooh, you see, Lutfey is still shocked.
After all...
Here's the argument, because the thrust of macroprudential regulations has been fewer banks, bigger banks, the same belief of risk, the same reaction to risk. Therefore, the regulations have increased the inherent pro-cyclicality of the financial system. You amplify the booms, you amplify the busts, and that translates directly into systemic risk. So the belief that if you make everybody prudent, you make the system safe, is an inherently wrong idea. So the banks, of course, were quite able to cope with COVID-19 last year, and no problem with Russia and Ukraine. But those were shocks from outside the system. And JP and I, we've developed the notion of endogenous and exogenous risk, which is a risk arising from within the system or from outside the system. In 2008, the crisis happened within the system, why it was so dangerous, while in 2020 and 2022, within the system. And I can promise you two things. A, there will be another big financial crisis. B, it will happen elsewhere than the last one.
JP had a question or comment to make, I think.
Why not? Thanks, Lutfey. Work. I guess the one question that I have is, how do we make financial institutions help the growth in real economy? I think that is the question I want to drill down. And then how exactly do you guys want to actually achieve that? I mean, what sort of financing could be improved? Is it like more debt, different debt, or is it more equity? So I wanted to have a little bit of your views on, should these new regulations allow new ways of financing? Which sort of financing? If it's long-term, should it not everything be equity? Should we not, have less debt and more equity, or long-term debts perhaps that can be translated into equity by converting it or some? So do you have any views on what sort of finance would you like the regulator to push?
Yes, definitely more equity, and also a combination of sort of maybe private equity, as for the reasons that Robert was talking about, and also public equity. I think there's actually a big problem in the UK in sort of equity, sort of in the post-startup phase. between as companies start private and then they sort of grow a little bit. Then in the UK, you really hit a wall if you're growing. I think and the regulator hasn't. When you think about is there when you look for problems in the market, you see there are a bunch of firms that should be there that aren't there, and so they don't really show up on the regulatory agenda because they're just not there. They're not they don't file forms. They don't, as Ava was saying, they don't file forms. They don't file complaints because they don't exist, but they should exist, right? And so that's the sort of thing you might see if you had a broader kind of conception of how well markets are working. You would say there's this gap, and there isn't sufficient supply of equity capital for risk-taking firms, and that's something that we should think harder about how to fix, right? And maybe somehow tapping into pension funds or something. There's some way of doing that. That is that I think is a real issue for the UK.
So should Charlotte do something about this? Would insurers be the natural supply of these long-term equity holders? And should Solvency II then not be changed completely as it discourages exactly those type of equity holdings?
Well, so I wouldn't argue that Solvency II should change, because Solvency II is very focused on annuities. I do think when it comes to accumulation of pensions, the rules around, how things can be invested, do drive towards the gilt market. They do drive towards, the equity market, but not in terms of what we might think of as infrastructure assets, real assets, the real economy, because the natural thing, if you're an insurance company and you have liabilities that go over 20, 30, 40, 50 years, you can afford to, invest over 20, 30, 40, 50 years. That's your ideal. You're not looking for a return over 2, 3, 4 years. And so I think that there is more that could be done to try and bring that together and really kind of think, how do you make that system work? Not to bring in, insurance companies are remarkably dull, in terms of what they want to invest in. We like wind farms, we like solar panels, and, we get very excited by electric vehicle grids. The minute somebody starts to talk to us about hydrogen, it's like, oh, no. That's not what we do. We like buildings. We like dull things. So I think there is something about how do you just bring that together a bit more effectively, and you don't have to do much. The numbers are eye-wateringly big. So with something like Solvency II, some of the changes that we've suggested, would lead to 100 billion more in investment in infrastructure. That is an extraordinary number, But in terms of what that means for insurance companies, what that means for stability within the sector, it's a fairly small change in the grand scheme of it.
Yeah, so I would argue that the financial regulations shouldn't get involved in promoting real economic growth, because it's hard as it is to protect investors, and that further muddies the water, puts the regulators into the political space, and then gives a license to the government to, help themselves to pension assets, to fund infrastructure projects. I think that's just a bad idea, especially if we now have a government that needs to deliver in 18 months to 2 years to generate growth.
So can I come back on that? So I'm not arguing that what you're suggesting. What I'm suggesting is it's really up to the insurance company. It's up to the pension trustees as to where that money is invested. But the barriers to investing there and the regulations that stop you from investing there are the issue. I completely, politicizing and saying, I'm going to take your pension and I'm going to invest it in my constituency in some, vanity project, is an absolute disaster. But it's about how do we make sure the regulation works so that the decision makers and ultimately the people whose money it is can get the right return, the right options.
So, last orders, any more questions? Okay, if not, for the panel, any last comments that you may want to make? If not, maybe just a one-liner answer to the question as to, given the state of regulations as they exist right now and the trajectory that is visible to us right now in the UK, how optimistic are you on a scale of 1 to 10 that it is going to help power the growth and a break from the past that is now being envisaged in the UK? We'll start with you.
So this is the first time we've had a government that's both committed to growth and committed to financial reform at the same time. And so there's an incredible opportunity here. Whether or not they take it or blow it is up to them, I guess. But at least, there's some more than in the past, right? There's at least the possibility of something fantastic happening.
6 out of 10?
7 even.
7.
Yeah.
Yeah, I'm fairly certain there are certain areas of financial regulation that will change over the coming years. I think on the whole they will be beneficial. I would be generally pretty optimistic. I question Kevin's suggestion. This is the first time a government's cared about growth and financial regulation, though. I don't know any government that doesn't care about growth and financial regulation.
Yeah, so I find this hard to quantify, but I'm going to adopt a cynical approach, and I'm going to say I think chances are 0. I think they'll just keep doing what they're doing, and then there'll be a way of arguing that there has been growth, and that's that.
Before you're that, Senator Gomez, I'm going to write up this meeting and send it to the government, and I'm sure that will influence them.
So the market right now is 7, and the lower bound.
I am usually the most cynical person on the panel, and I guess I'm not. I'm going to say 8. And the reason is the government is so desperate to get growth that it will try anything, and what gets in the way of reform of regulations is the lobbying power of the incumbents who do not want to change. That's a primary reason. And the second reason is the innate conservatism of the regulators who don't want to do things differently. And I think this government might just have the cojones to address both because it's desperate. So it's 8.
Great, but if we were solving for diversity, we have got it, so diversity. And with that, our time is up. So, ladies and gentlemen, let's give a round of applause.